everybody. My name is Andile Jonas and I'm the head of marketing for MFP. Thank you for joining us today and welcome to the last Outcome Matters event for the year 2022. We're going to be saying that a lot over the next couple of weeks, I imagine. The last this and that for the year 2022. But maybe that's a good thing. We've had a lot of firsts, haven't we? The first pandemic in my lifetime. I also saw both the British and the Zulu King coronation in my lifetime. Very different ages, of course, but interesting to see nonetheless. I even got to experience my first Santon terrorist attack threat. So, maybe it's time for a few lasts. Some of them, of course, were very sad. The last time we saw Angela Lansbury, Sidney Poitier, and Olivia Newton-John. I don't know how many of you out there know who these people are, but icons in the film industry. The last time we saw Roger Federer, for the tennis fans out there, very, very sad. And yes, I know some of you are thinking you hope it's the last time you see me on this virtual stage as well. Well, that's too bad. So anyway, before we start with the session, just a few housekeeping points. We applied for continuous professional development points. I know this is very important to you, so please watch the full session and add your ID number to the CPD section so we can verify your attendance. Our event platform will remain open until the end of December for you to still view this event and still receive your CPD points. You'll receive a separate email from Momentum Sales Academy with your CPD certificate during January 2023. Please post all your questions that you have for the speakers in the Q&A section, and we'll make sure we try and answer each and every one. Okay. Guys, you're also welcome to use the chat functionality during the session. We'll be engaging on there as well. First up is Kapil Joshi. He's the head of MCI, and he's going to give us an update on MFP House View support.
Thanks, Andile. Good day to all of you, and thank you for joining us for our last Outcome Matters for this year. And what another year, right? I am still attempting to catch my breath with what has been a whirlwind of experiences in investment markets. As our speakers have shared, the third quarter of 2022 was beset with elevated global market volatility, with financial markets still facing headwinds looking forward. However, during these uncertain times, it's the simplest attributes of patience and looking through market noise that carries investors. As we look back, most of you will recall that we partnered with MFP to match your advice process with an in-house house view strategy in April 2021. We acknowledge that it is still early days for our strategy and your adoption of it is still an ongoing journey, but we still anchor our belief in our partnership with MFP that this is appropriate to lessen the advice risk that each of you sit with. It is at this point that we would also like to thank you for your continued support, which includes receiving the updates at Outcome Matters, our flagship conference for MFP. I would like to pause and share some of the financial highlights. The slide on your screen illustrates the number of supporting planners, inflows and assets under management for the house view, both prior to its launch and where we are now. We have seen growth in the number of planner support for our multi-asset funds, the MFP Focus Model Portfolios and the Momentum Focus Fund of Funds. As at the end of the previous quarter, our MFP Focus Model Portfolios had a healthy AUM of 837 million Rand, supported by 181 planners. The Momentum Focus Fund of Funds had a 17% increase in AUM and an increase of 14% of planner support from the initial start of the house view. Our fixed income funds had a 5% growth in AUM and a 4% increase in planner support. Keep in mind, these are already well-established capabilities in MFP. There has been a slight decrease in planner support and fund growth for our feeder funds and direct funds, which we all know is due to the continuous global market uncertainty. As most of you are aware, our multi-asset solutions have CPI-linked objectives, and the solutions are market-linked. In this tough environment where inflation is above 7%, it has been incredibly tough to achieve these objectives. But our key message has always been that investing for the long term should commensurate investors with an inflation-adjusted return to grow wealth. Often, this is not what we see, as you have either read or even seen at Outcome Matters with the research that Paul Nixon conducts. On this slide, you'll see that our research has proven that buying and selling with these short holding periods is a recipe for disaster. Investors cannot control a market crisis, but they can control how they respond. Expanding the holding period to 6 years eliminates all the red color-coded returns, but we still see a few areas of white, which any investor in risky asset classes would still view as disappointing. These areas can be largely eliminated as we expand the holding period to 8 years. In fact, holding periods of longer than 8 years have historically guaranteed South African equity investors a return of more than 5% and in most cases between 10 and 15%. This is at the very least an inflation-beating return. This is shown in Figure 1 by the shaded yellow triangle labeled accordingly. Figure 1 ends at 2019 to show how this is changing. Getting a guaranteed return of more than 5% now requires a far longer holding period. This is a key takeout message that you need to incorporate into your advice process and your narrative with clients in order to manage expectations. In closing, I want to leave you with a few key messages. Investors need to spend more time in the market to get an inflation-related return. Looking backwards, this has shifted from 8 to 14 years. Your advice process needs to evolve to accommodate these fundamental shifts due to market changes. Our investment approach is anchored in assisting you and your clients to take these tilts into account, but is also critically matched to your advice process so that we partner with you on the house view and make it your own. And finally, a few success stories to leave you with as a high as we begin to wrap up the year. Momentum Investments business made great progress over the year with the following achievements that I want to highlight. We have successfully trained and upskilled more than 250 new MFP advisors on our holistic product offering. As I mentioned earlier, we saw strong net flows from the Equilibrium business to MCI funds over the last quarter and financial year. The go-to-market strategy in relation to the MFP house view is starting to gain traction. Just over a year ago, we announced our new partnership with FNZ. Ever since, we have been working hard to ensure the necessary focus on the program to transform our platform business whilst running our business of today. Watch this space. The Momentum Trending Equity Fund and the Momentum Value Equity Fund delivered a stellar 5-year track record during the quarter. The Momentum Trending Equity Fund is used as one of the underlying funds for our Momentum Focused Fund of Fund range. From an operations perspective, to continue delivering on your request, we have successfully completed the MCI Minimum Disclosure Document project, or as you know them, Fund Fact Sheet rebrand, for the quarter, and the new MDDs were made available in August 2022. Operations are now striving to publish the new MDDs within 10 working days, which is what you come to expect of us, right? We cannot do this without your feedback and support. I therefore invite you to continue to partner with us, to continue to adopt the MFP house view, and to continue delivering improved advice outcomes for your clients. Thank you, MFP, and we wish you all of the best over the holiday period. See you in 2023, and we hope that investment markets play ball.
Thank you, Kapil. Insightful as always. Next up is Momentum Investments economist Sanisha Pakrasamy. She's going to highlight some of the biggest surprises of 2022 delivered to financial markets. She will also take a peek into 2023, highlighting key themes and the outlook for growth, inflation, and policy rates in the global and local environment. Sanisha, welcome to the virtual stage.
Thanks, Andile. Hello, everyone, and thanks for joining us today on MFP Outcome Matters. Despite the new Omicron variant of COVID-19 knocking at the door to the entrance of this year, people around the world were feeling surprisingly positive about the prospects for 2022. A poll conducted by Ipsos in 33 countries found that 58% of those surveyed experienced the year 2021 as bad for themselves and their families. However, more than 3/4 of respondents expected 2022 to be a better year. A number of factors influenced the upbeat expectations of respondents for this year, including 1. Progress on vaccination programs, 2. Optimism around the readiness of nations to tackle climate change, 3. Expectations for a more tolerant society, 4. Projections for lower stock market volatility, and lastly, an improved global backdrop. In contrast, however, things played out quite a bit differently for 2022. Large swaths of Africa remain unvaccinated, and although many countries relaxed onerous lockdown restrictions, China suffered intermittent lockdowns as part of its stringent zero-COVID strategy. Not only were China's domestic logistics disrupted, but these lockdowns also had a compounding effect on already tangled global supply chains, which further fueled elevated inflation. Moreover, Russia's war of aggression against Ukraine blew the global economy further off course, with economic activity slowing in many countries. Inflationary pressures that were already present as the world economy emerged from the pandemic were aggravated by the war. Food and fuel costs in particular soared, resulting in a deterioration in living standards for citizens across the globe. Acute energy shortages and skyrocketing prices of fuel and food resulted in many nations taking to the streets and protesting against the soaring cost of living. With rising price pressures posing the most immediate risk to real disposable incomes, central banks have narrowed their focus on restoring price stability. As such, interest rates have ramped up significantly in a short space of time. Tighter global financial conditions have pushed already vulnerable emerging markets into deeper debt distress as the cost of borrowing increases around the world. Prospects for growth in 2023 have dimmed considerably. At the start of this year, the consensus expected developed markets to grow at 2.4% in 2023. However, this projection has faded to 0.7%. Similarly, financial markets were looking forward to growth of 4.8% in emerging markets next year, but these forecasts have since slipped to 4.3%. This is in spite of a better expected outcome for China in 2023. Continued conflict between Russia and Ukraine, an acute energy crisis in Europe, persistent inflation, tighter global financial conditions, and a rise in the cost of living continue to raise red flags to the growth outlook, which has already been downwardly adjusted. Cost of living pressures already started to intensify during the pandemic. Restrictions on economic activity created supply chain disruptions, which drove up costs given the rise in demand, which could not be adequately met by the available supply of goods. Moreover, trends such as the Great Resignation led to shortages in the labor market and put upward pressure on wages. Higher growth in worker compensation then threatened a broadening out of inflationary pressures. Favorable base effects in goods inflation and reduced pressure in global supply chains will likely take a lot of the wind out of the inflation we're experiencing right now. However, inflation in services and wages have become stickier. Even with an aggressive front-loading of interest rate tightening cycles, a quick turnaround in central bank targets, especially in developed economies, is likely to take some time, particularly as monetary authorities are urged to divert their attention from elevated inflation to weakening growth fundamentals. During the course of 2022, inflation forecasts for 2023 drifted higher, reflecting the slower than expected return to central bank targets. As economies start slowing down and as financial fragilities emerge, calls for a pivot towards looser monetary conditions will inevitably become louder. The World Bank's acting vice president for equitable growth, finance and institutions noted that, quote, recent tightening of monetary and fiscal policies will likely prove helpful in reducing inflation. But because they are highly synchronous across countries, they could be mutually compounding in tightening financial conditions and steepening the global growth slowdown, unquote. The International Monetary Fund, or IMF, warns that now is the time to rebuild fiscal buffers. Fiscal policy must work in concert with monetary policy, otherwise the IMF warns the fight to douse inflation will only be prolonged. More recently, financial markets in the United Kingdom punished the former administration led by Liz Truss when she delivered budget proposals including large increases in spending and significant tax cuts that markets expected would only spur inflation and necessitate even more tightening in monetary policy. While previously developed market governments could enact fiscal stimulus without worrying too much about higher inflation, we have now shifted to an era with more explicit policy trade-offs. While the previous UK administration was applying the old framework, financial market participants forced more fiscal responsibility in a time of higher inflation and tighter monetary policy. The World Bank points out that the fraction of countries tightening fiscal policies next year is expected to reach its highest level since the early 1990s. As such, this could amplify the effects of monetary policy on growth. Several historical indicators of global recessions are already flashing warnings. Business optimism and consumer confidence surveys have tanked. Negative housing sentiment, inverted yield curves, grim stock markets, and subdued leading indicators all point to worsening conditions ahead. A Bloomberg survey of contributing economists predicts the probability of a recession in the United States over the next 12 months has risen to 60% from 15% at the start of the year. Similarly, the risk of a recession in the UK has gone up from 15% to 80% over the same time frame. The Eurozone stands out as having an even larger recession risk attached to next year's growth outcomes, with the risk for Germany climbing to 90% from less than 20% at the start of the year. This coincides with the German IFO Business Climate Survey dropping to levels last seen during the global financial crisis and at the onset of the pandemic. Central banks are nevertheless primarily focused on bringing inflation down, even at the risk of a recession. The IMF acknowledges the difficult course monetary authorities have to chart and warn that the risk of policy errors remains high. Although an over-tightening in interest rates could tip economies into an early recession, not tightening interest rates by enough could result in inflation becoming far more entrenched. This would result in an even more hawkish stance in the future, which would damage growth and employment prospects by an even larger margin. As such, the IMF guides central banks towards focusing primarily on bringing inflation down, even though this might risk a fallout in growth. At the time of filming, policy rates are not quite restrictive yet in all markets. Real interest rates are still negative for economies such as the UK, Eurozone, Japan, and Australia after extracting 1 year ahead expected inflation. Although central banks are approaching a peak in hawkishness, with signs of inflation starting to roll over, an actual pivot toward an easing in monetary policy is still seen to be a few quarters away, as reflected in these market-implied policy rates for key economies. A hard landing scenario should not be underestimated for the US economy. But this time around, unemployment rates remain close to multi-decade lows due to long COVID, early retirement, less migration, and even changing attitudes to work. Moreover, household wealth and savings remain supportive for the US consumer. Capital positions of banks are stronger than prior to the global financial crisis. Central bank credibility is more intact than during the 70s, and even though the housing market is faltering, we are not experiencing anything close to the housing market collapse during the global financial crisis. As such, even though we are expecting a mild negative print for growth in the US for 2023, we suspect the drop in growth will be shallow and relatively short-lived. Nevertheless, prospects for the European Union remain far more dire. The gas crisis spurred by the Russian invasion of Ukraine is likely to sharply reduce growth prospects for the region for 2023. This is in spite of adjusted consumption patterns and new gas import infrastructure facilities, which could alleviate the impact of gas shortages from 2024 onwards. The Financial Times reported that the European Union has set a target for most countries to cut gas usage by 15%. Despite efforts to diversify import sources, particularly into liquefied natural gas, supply is unlikely to meet demand. While the Ipsos survey at the start of the year, which left people more optimistic about 2022, partly hinged on optimism around the readiness of nations to tackle climate change, fighting climate change has in fact taken a backseat. Coal has now become the go-to alternative in the current energy crisis. We are edging closer to rationing becoming a necessity, and this is expected to amplify economic disruptions. Moreover, capacity to ease monetary policy to help offset the negative impact on households and businesses remains heavily constrained due to the need to tackle high inflation. High inflation continues to erode consumers' disposable incomes and corporate profit margins, while a more fragile economic outlook has weighed negatively on capex decisions. A combination of alternatives to Russian gas imports and slowing demand have meant that inventories have stayed high, but much depends on the severity of the upcoming winter season. Although gas stocks in the European Union are more than 90% of capacity, building this cushion has come at a high price. Forward contracts in countries like France and Germany are priced more than 5 times higher than a year ago. And even if stocks are sufficient for winter, reserves will fall to lower levels, pushing supply problems into the future. The efficiency of measures put in place by the European Union will depend on the willingness of member states to coordinate supplies and share energy. As soaring energy prices have sharply raised living costs for Europeans, governments have come under enormous pressure to protect lower-income households. These rising political pressures may prevent more systematic cooperation within the European Union, particularly in light of right-leaning parties gaining prominence across the continent. The September general elections in Italy resulted in the right-wing alliance of political parties winning the highest share of the vote. This victory was then celebrated by both Hungary and Poland, given these governments' shared interests and values. Events over the past 3 years have left emerging markets in a more delicate state. The economic impact of the pandemic and rising food and fuel costs on the back of Russia's invasion of Ukraine have pushed a number of vulnerable emerging economies to the fiscal brink. Higher real interest rates in the US and complex geopolitical tensions have bid the US dollar stronger. This, together with rising borrowing costs around the world, have driven up the number of emerging markets that are either facing debt distress or are already in actual default. Chronic debt and economic mismanagement in many developing nations have eroded governments' ability to support vulnerable populations. Widespread discontent over rising living costs is evident on the streets of developed and emerging markets. One of the reasons consumers expected a more upbeat year when surveyed by Ipsos at the start of 2022 hinged on a more tolerant society as we were about to enter the 3rd year of the pandemic. However, in contrast, COVID worsened inequality between regions and within countries, and socio-political divisions have widened, resulting in angrier citizens and higher levels of unrest. While global risk intelligence company Verisk Maplecroft has noted that over half of the world has experienced increased civil unrest since the onset of the pandemic, they warn that the worst is yet to come. The good news is that Asia is likely to be a bright spot, even as the global economy is expected to slow significantly. While it is true that rising global interest rates, the war in Ukraine, and stuttering growth in China slowed the momentum behind Asia's rebound this year, going forward, Asia's path is expected to be very different to that of advanced nations. With inflation remaining broadly intact, select Asian central banks have not been forced to tighten aggressively, leaving more headroom for growth-oriented policies. Further growth in tourism and supply chain diversification will boost growth in a number of Asian economies, while a gradual loosening of zero-COVID policies is likely to fuel a recovery in China. Nevertheless, property market woes may spill over and leave growth in economic activity falling short of Beijing's 5.5% target. Although globalization has not clearly shown up in the data showing cross-border movement of goods, services, and people, international economic ties can break down quickly. The US continues to push for policies to reduce economic dependence on China, such as recently seen in the semiconductor space. In our view, rising nationalism and socioeconomic stress are likely to continue to change the face of international trade in the coming years. In this light, 2023 is expected to show further signs of decoupling between the US and China. Against this backdrop of dimmer global growth, a slow grind lower in elevated inflation, and geopolitically a more fragmented world, growth in South Africa is expected to moderate from sub 2% in 2022 to around 1.5% in 2023. Consumers are facing a higher cost of living, fading wealth effects, and muted employment prospects, while businesses are constrained by softer demand, a staggered pace of economic reforms, energy and logistic hurdles, as well as lingering policy uncertainty. In addition, exports are set to weaken on a moderation in global demand. Meanwhile, inflationary pressures are expected to unwind from around 6.7% this year to above 5% next year on the back of past monetary policy tightening. While fiscal authorities are likely to remain committed to fiscal prudence, continued social demands, support for parastatals and financially bankrupt municipalities will continue to be a drag on expenditure and threaten the projection for debt to stabilize. In summary, this new regime of larger tail risks, high uncertainty, and elevated volatility is expected to continue playing out in 2023. Until inflation has shown a clear downtrend, it seems likely that higher global interest rates and balance sheet reduction will remain the order of the day, with synchronous tightening steepening the slowdown in the global economy. As such, fiscal and monetary authorities have to be ready to deal with the potential spillovers and may have to pivot later in 2023 when growth risks sound louder. Financial markets have had a tough time this year, with significant drawdowns and high volatility. While sticky inflation, tighter policy, and rising recession risks point to more potential downside for 2023, we would urge investors to not attach a high importance to short-lived market falls, which could result in destructive portfolio behavior. Instead, investors should focus on the rationality of long-termism and refrain from making unnecessary changes to their portfolios. As we round off this year, we would like to thank you for your support, and we wish you a wonderful year-end break and a very prosperous 2023. Thank you.
Well, thank you, Sanisha. That's really, really powerful stuff. Next up, though, folks, is a panel discussion moderated by the head of Equilibrium, that is Flobella Yates. They're going to be discussing how they've been navigating the investment environment with the MFP House View funds. Welcome, Flof, and welcome to your panel.
Thanks, Andili, and hello, everyone. Phew, it's been a tough time to be in the asset management industry. The last 5 years, I think, have added an extra 10 to my life. So if you can see all the grey hairs, that's because I'm in investments. But seriously, since COVID, we thought that the market had turned around. The South African market specifically is particularly cheap, and we really thought that now a lot of the risk has dissipated. How wrong we were. In fact, if anything, the risks have increased. First, we saw the Russian-Ukraine war, then an increase in inflation around the globe, with governments starting to increase interest rates. Some governments too late to the party, sometimes too severe. Other governments have made complete mistakes and had to then backtrack. And even locally, we've had to deal with not only what's happening at Eskom and the power load shedding that each of us has to deal with on a daily basis. Now it's the water issues. And in addition to that, our market is cheap, but it just doesn't seem to play out. We're not seeing a turnaround in that market. It's been a particularly difficult time to be in the asset management industry, and we take our investments seriously. So I'm honored to be joined on the panel today by the experts. To my immediate left, Dean and two along Ronnie, the two portfolio managers on the MFP range of Houseview portfolios. So just to remind you, that is the MFP Focus Model Portfolio range, as well as the Momentum Fund of Funds range. In the middle, the head of fixed income at Momentum, our fixed income expert, Ian. And then on the left, opposite me, the lovely, gorgeous Natalie, who is the fund expert on our Momentum Global Investments offshore portfolios. Thank you for joining us. Now, 2022 has been an unusually volatile year for financial markets. Ronnie, let me come to you quickly. How concerned are you about the impact that this has had on the MFP Houseview multi-asset solutions? And were the impacts in line with your expectations and your modeled drawdowns?
Yeah, Fluff, certainly it has been a very volatile year to date. But, in investments, we should expect short-term volatility and drawdowns. It's sort of part and parcel of being in investments. And we shouldn't be too surprised, given that we've already modeled for this in our strategic asset allocation of the funds. Now, in terms of how the funds are constructed, we have a rolling 12-month drawdown limit per fund. That limit sits between 2.5% and 10%, depending on the aggressiveness of the fund. And as of end of September 2022, we have not yet breached those limits. So far, October has rolled out to be quite a good month. We don't know what the rest of the year is going to hold for us. But as the fourth quarter of 2021 starts falling out of that 12-month history, we might be getting close to breaching some of those short-term VAR targets. And I just want to remind everybody that those risk budgets are measured with 95% statistical probability. The other 5% is, of course, there for periods like these, your typical black swan events, recession periods, etc. So even though you might breach those risk budgets in the short term, it's not necessarily something to be concerned about in the longer term.
Okay, thank you. Dean, what actions have you taken in the portfolios in recent months?
Look, to be honest, Fluff, there hasn't been a lot of changes. Of course, tactically, we're looking at the markets every day. But as Ronnie said, it's been a very volatile year. And I mean, for us, we've been on the right side of that. So for quite some time, we've had a preference towards local asset classes over global asset classes, particularly local equity and local bonds. And, for the year to date, that has worked for us. And so we've remained quite comfortable with the positioning of the portfolios. And I suppose in volatile markets like these, of course, opportunities do arise and you can take advantage of those opportunities. But very similarly, with this level of volatility, it's so easy to take a wrong step, and that could be to the detriment of clients. So, in markets like these, we try to stick to our principles and just make sure that the portfolios are positioned as we would have expected them to be positioned, based on the fundamentals in markets, and then we just ride out the short-term noise in order to pursue the sort of longer-term objectives of the portfolios.
Okay. I like that, disciplined. So given the recent changes to Regulation 28, has that resulted in you making any changes in the portfolios?
Certainly. So obviously, Regulation 28 opened up the offshore investing spectrum for us. It obviously went from 30% offshore exposure with 10% additional to Africa, now to 45% offshore. And with that increased offshore limit, that obviously gives us more leeway to achieve the overall portfolio objectives in perhaps a more efficient manner. Now, we've recently gone through the exercise to re-optimize the strategic allocations of our portfolios. And so what that means is that we arrived at a new optimal strategic asset allocation for each portfolio that represents our best opportunity set to deliver on the portfolio objectives. Now, having said that, there obviously hasn't been a lot of opportunity to come very close to those, particularly in allocating to offshore, given firstly our preference towards local asset classes. But in addition to that, the rand has obviously been particularly weak, and of course we said that at 17 and it weakened even further. But in markets like these, you don't want to be expatriating cash at 18.35, because inevitably it will come back. And so again, we stick to our principles, and over time we will get to those strategic allocations, but of course we don't want to rush that to the detriment of clients. At the end of the day, we are portfolio managers rather than just implementers of research.
And I guess to Ronnie's point earlier, you also want to make sure that in the more conservative portfolios, you're not going to the maximum offshore allowance, because that rand movement can have a huge impact. And the timing of moving offshore is obviously very important. They're very valid points from both of you. I think I'm going to move to Ian now. Ian, is cash still king, or is it now queen, or has it reached the time when it's been downgraded to the poor cousin or pauper?
Fluff, cash at the moment is the whole royal family. King, queen, and everybody. I think it's quite important to understand that there's two things about cash at the moment. Given the volatility in markets, cash has just outperformed any other duration asset class at this point in time. So we've had the highest returns from cash. But secondly, I think what's quite important in volatile markets, to us, cash is fighting power, right? So when markets sell off and you get these bouts of excessive volatility, and it's basically just markets just sell quality off at any price, that's when we find that cash in our portfolio is hugely valuable, because that's when we can suddenly in South Africa buy the 12% yields in the long end of the yield curve. We can buy 8.5% 1-year NCDs. We can buy 11.5% 10-year bonds. I mean, that's incredible, because if you don't have cash in your portfolios, you can't utilize these opportunities for the longer term, because it's typically in markets like these, you get the Warren Buffett type saying, where you say, plant a tree today to sit in the shade tomorrow, and that's what cash does in your portfolios. You'll be able to plant that tree today because we want to sit in the shade next year, and we think we'll sit in the shade next year, but it is going to be tough this year. So cash is important in our portfolios.
Okay, and using your analogy, I guess if you're planting a tree, you've also got to have a little bit of patience. So hold on to that cash until you see the opportunities. Nats, in what has been a torrid year, 2022, talk us through how the offshore portfolios have done in terms of performance.
Yeah, Fluff, I mean, as you said, torrid is a mild word to use for the global markets. It's global markets, especially if you compare it to South African asset classes. At least you could hide somewhere in South African asset classes. Globally, there was pretty much nowhere to hide except cash, especially US dollar cash. US dollar cash, a bit of commodity exposure, I suppose, would have helped a little bit in terms of performance. But pretty much for any multi-asset global portfolio, there has, as I said, been nowhere to hide. And as a result, the performance of the 3 global multi-asset portfolios that we manage, of course, have not been immune to the broad-based sell-off. And what's been particularly unusual in terms of this market sell-off has just been that all asset classes have been selling off in tandem. You've had risk assets as well as your traditional safe haven assets selling off in tandem, which has been one of the first circumstances in many, many years. Particularly if you look at US Treasury bonds as an example. I mean, normally that's seen as a safe haven asset class. Now, over the last 45 years, this year-to-date performance of US Treasuries has been the worst ever on record. Now, that just highlights how difficult it's been for multi-asset investments in the multi-asset funds, should I rather say, in the global space, because normal asset classes in terms of those safe haven assets, when markets are selling off, risk assets are selling off, bonds normally provide protection, but we haven't had any of that. And of course, the one benefit of this market environment is that cash has been giving a bit of optionality. So as markets sell off, more and more opportunities are starting to arise, and that's where our team in the UK are starting to look to take advantage of as and when we see value. But it's been a difficult market environment.
Great, thank you. I think, Ronnie, my next question is coming to you. There are obviously some differences between the 2 ranges that we manage for MFP. And how they actually managed and executed. For example, in the benchmarks, tactical asset allocations, and maybe even in the underlying strategic allocations, how often do you and Dean and the rest of your teams discuss the ranges? And do you have any plans to maybe align them more closely?
Yeah, Fluff, you are correct. There are some differences between the 2 fund ranges. We have, however, embarked on exercise to align the 2 fund ranges more closely. So from an MFP perspective, it is one house view, and we want advisors and clients to choose the best investment vehicle for their needs and not necessarily based on an expectation of differences in the benchmark or the risk budget or performance at the end of the day. So in terms of Dean and I, we do meet quite regularly. We've been working together to align the strategic asset allocations of the two ranges. So that is sort of the first step in the process, and that is also the most important step. So we've already completed that exercise. The next step is then to align within each asset class from a strategy perspective. And then the final step would be within each strategy, in each asset class, to align the mandates or the funds that we use to execute. Now, we don't want to rush the process just for the sake of alignment to the detriment of clients. So we'd rather do it correctly, but it is quite far along. And we are quite excited to get that alignment implemented as soon as possible.
That's fantastic. I think the biggest advantage to you as advisors within the MFP House View Solutions is that you actually have two phenomenal ranges to choose from. And it's up to you to decide which is more suitable for your clients. Would they be best suited to a fund of funds, because CGT, for example, could be a real issue for high net worth investors? Or do they want so much transparency that they prefer the execution in the model portfolio? But at the end of the day, you've got two ranges aiming to get you to the same outcomes over the same time horizon with the same drawdown or risk budgets. So it gives you a lot more optionality than most advisors in the market would have. So that's fantastic to hear that you're way along. Ian, allow me to segue to you with my next question. Give us an overview of what is happening in the fixed income space, and please don't only talk about cash.
Cash is important, but let's park cash for the moment. But yeah, I think what's really happening at the moment is that the central banks are squeezed between two very strong macroeconomic forces. That there's obviously you talked about inflation. There's a very strong momentum of inflation at the moment globally, and we know why, due to energy and food prices. But then if we look on the other side, there's this big fear of recession, and now the central banks are basically squeezed, and they are focusing really on that front end, and they're worried about this elevated inflation. We're not making light of the very high inflation, especially in the developed world, and these central banks are feeling that they have to address inflation, they have to hike rates, and they have to be hawkish. But I would caution them and say, look, the old adage of don't fight the Fed is very true, but I would also say to the Fed, don't fight the bond market, because the bond market is signaling a higher and a rising probability of recession, especially in developed markets. I mean, if you think that suddenly the market is now looking probably for a 60% probability of recession in the US, probably 80 in the UK, and probably around 60 for the European Union as well. So at some point the bond market will tell these central banks that the rate hiking cycle has to come to an end. So if you say to me what's going to happen, you're probably going to find that for most part of 2022, these global central banks are going to hike interest rates, including the SARB. They'll keep on hiking because I think in the back of their minds they also have probably worked out that the window of opportunity to hike rates is probably coming to an end, and that they will have to hike interest rates for most of 2022, because let's get to 2023. I think we're going to get to a point where they're going to work out that the economies just cannot take this amount of pain. And if we think that most consumers in the world are probably triple taxed at the moment through high food prices, energy prices, and now interest rates, yes, I think at some point, and I'm sticking to the view that yes, they're going to be aggressive, they're going to hike rates, but yes, at some point next year the market will probably force them to cut rates. And I know it sounds unbelievable at this point in time, but I just think that as fast as inflation moved up, it can come down again. So yes, I think that's what's happening in fixed income markets. We've got this inverted V of a painful 22, but I think there's relief on the horizon for 2023 in fixed income markets, and because that's what the market is telling us if we look at the inversion in especially the US curve.
And locally, is that any different?
No, I think the SARB is going to be on exactly the same path, because, I mean, we heard the governor speak yesterday, and he's obviously still very hawkish around inflation, but at some point they've got to admit that the South African consumer is quadruply taxed because we've got the electricity issue as well. And I think at some point the weakness will come through. If you think that the SARB, National Treasury, even Sanisha, we're all looking for about 1.5% growth next year, which is not nearly enough for an economy like South Africa. So at some point, we also think that inflation could materially come down in 2023. And I think as soon as inflation falls, we sit at 1.5% growth. The fiscal metrics look okay from the government budget side. I think the SARB will have every reason in the world probably to cut rates.
Okay, Dean, give us an overview of the portfolio performance in both sets of solutions. So in the fund of funds as well as in the MFP model portfolios.
Thanks. Also, yeah, I suppose, like Natalie said, it's been a tough year. Yes, we've been on the right side of it with local asset classes, at least on a year-to-date basis, somewhat outperforming global asset classes. That being said, South Africa and South African markets are part of the bigger global economy, and we are not immune to sell-off. So while the sell-off has been, somewhat less severe, we have still seen sharp sell-offs in our growth assets, equity and property. Bonds has been, relatively flat, somewhat down in certain months, and so the portfolios have obviously struggled, particularly to deliver, decent absolute returns. And of course, when you then compare it to the benchmarks of the portfolios, real returns have been especially elusive. So in an environment where CPI is going up and markets are going down, the gap between, the portfolio's delivery as well as the benchmarks, the real return benchmarks that we've set ourselves, they're obviously going in divergent directions. Now, that being said, we obviously aren't short-term investors, and we've got to look, more over the long term. And I suppose while we can say that portfolios have struggled to achieve real returns over the longer term as well, it's because we've also seen subpar real returns from local asset classes. And in fact, asset classes globally, over the last 7 years, the only asset class that would have allowed you to come anywhere close to, say, a CPI plus 5 objective would be global equity. But of course, we can't put everything in global equity, not just because of Reg 28, but that also wouldn't be very prudent. So having said that, how do we then appraise ourselves if it's been very tough to achieve the CPI plus objectives? Well, we look at how do we compare then to the long-term strategic asset allocation performances of the portfolio. So we do have strategic asset allocations for each portfolio, and what we can say, at least what we are, see as positives, is that across, the entire fund of fund range, and even within the model portfolios over the short history, we have been able to outperform the strategic allocations. That means over and above what we think is the benchmark rate of where you want to be in asset classes, our tactical asset allocations, the strategies that we employ, value momentum growth within the equity space, for example, and then beyond that, the mandates that we've chosen to execute on those strategies have all added value to the portfolio's performances. And maybe just one final comment on a peer relative basis. Of course, again, model portfolios have a very short history, and since their launch, they are performing very much in line with peers. And speaking more to the fund of fund side, we did have a bit of a tough year, particularly 2018 and 2020. But as we saw the recovery in 2021 and some of the mandates that had underperformed in that time starting to come through this year, our peer relative performance has also improved dramatically.
Yeah, so I know as outcome-based investors, we're not peer cognizant. So we don't manage portfolios to try and outperform the needs, outperform the peer group. And that's because we speak to advisors and advisors' clients. And when advisors give advice, they typically are trying to solve real-world problems. So it doesn't make sense to say, oh, well, the portfolio's done well, it's outperformed the peer group, but the peer group's negative and your client needs a real return in order to have sufficient cash to retire on. What I see as very pleasing in both ranges is when I look at the consistency of performance against the peer group. Both ranges have had much more consistent performance than the peer group in general, and I think there are two main reasons for that. The first is that the strategic asset allocation has been deliberate, so we've been invested, unlike the peers who sometimes change and don't invest to try and look good relative to other peers. And then the second thing is our discipline at making sure we stay invested and stick to our principles, as both of you actually alluded to. I guess a follow-on question, Dean, is how confident are you that going forward we're going to be able to deliver on the outcomes when you've got so many asset classes that are just not performing?
So look, I think it is definitely proving to be tougher than it has been over the last, call it 20 years. So I mean, if we just look at it locally, our expectations are forward-looking real returns on asset classes, but also, there's research done by McKinsey, if I'm not mistaken, that shows expected real returns from global asset classes have also been coming down over the last 30 years. And so, of course, when there's compression on real returns, that makes your probability of delivering on these objectives a lot tougher. Having said that, we do have the benefit of obviously the changes to Reg 28 and our wider opportunity set. And so with the consistent optimization of our strategic asset allocations, we look to try get to the probabilities of delivering on those objectives across the portfolios, and most importantly over their respective time horizons. Just strategically speaking, we look to get the probabilities around 65 to 70%. So that gives us roughly a 70% chance of getting there purely strategically. But then of course the work doesn't stop there. We obviously do optimize our strategies to try enhance underlying passive execution to just notch that probability up. So are we going to hit the benchmark consistently every single rolling period? Definitely not. Nobody can guarantee that. But what we can make sure is that probabilistically the chances are on our side, and we believe that we'll be able to deliver it as consistently as what we can. And I think what is important is that what we can control on our side is how much risk we are willing to take in the portfolios and over what period we think we should be invested in there. And so you can rest assured that over the periods we will be consistently achieving those risk objectives as well as the time horizon, of course. But then the returns, we will look to maximize the return we can get given the prevailing market conditions that we find ourselves in at that point in time. And maybe just one final point on that is, coming to your peer Cognizant's comment, is that, we never stand here to say that we are better than the peers or we are worse than the peers or this fund is better than that fund. What I think is important is that we have a deliberate focus on achieving the objectives that we have set. And I think, if anything, that makes planning for the advisors so much easier, because they can go to sleep at night knowing that the funds that they've picked for their clients are going to be consistently managed to solve a specific objective that is aligned to a financial planning process, as opposed to your point earlier where it's just relative to some peer group and the need of the client is almost disregarded in that environment.
Yeah, I think that's a huge advantage of being invested with a manager that follows an outcome-based investment philosophy, because it's much more aligned to an advice-led philosophy. So in my mind, when I think about it, it's different to saying, well, you've got a variety of different clients with different needs. Let's put them into a balanced fund that's trying to outperform the peers, and they may sometimes meet the objectives or be completely disaligned to the client objectives. Whereas here, at least, even if you don't get to the specific CPI plus target, you're at least aiming to get to a real return, which at least should give advisors and their clients comfort that they're being actively managed and that they should be aligned to what the client objectives are. So Nats, what are the key things that the team in the UK is worrying about?
Sure, Fluff, there's a lot. I think obviously we've already covered that the offshore markets have been tumultuous. And I think, obviously as investment managers, the team need to diversify their portfolios to ensure that, as best as possible, as you mentioned, our team can try to deliver on those return outcomes that they've promised clients over the 3 years, over the 5 years, and the 7-year period. But some of the areas that teams looking at or concerned about is inflation, in the sense that, is it going to be more persistent? We are of the view, just like Ian, that, if you look at the long-term inflation expectations, they're still pretty much range bound between 2 to 3% in the US. So the longer-term inflation expectations are relatively okay. Yes, inflation is around 8.2% currently, but I think that is a positive thing to look at. But at the same token, you have to be mindful that inflation, if it does surprise on the upside, that continually has surprised or caused volatility in the market. So that's a concern. Another area is obviously geopolitical uncertainty that we're seeing. We had a war at the beginning of the year. It's still ongoing. Is that going to escalate? Now there's concerns regarding China's potential invasion of Taiwan and what that means also between the West and the Chinese relationships. China, the growth outlook in China, it is the second biggest economy in the world. They've been in hard COVID lockdown. They've got the property issue there. They've recently, last year, they had that hard lockdown on the tech industry and on private sector education. So obviously, as the second biggest economy in the world, there's concerns in terms of what that means in terms of growth. And then I just think in terms of, longer term from our perspective, given that all this uncertainty is just so key from us as a business to make sure that we scenario plan and just stick to our guns of being multi-diversified in terms of strategies, in terms of the managers that we employ, and just where possible build in as much protection as possible to protect against uncertain investment environments, because at the end of the day we don't have crystal balls. No one does. We wish we did, but we don't, and so we just have to protect where possible, and that's what the investment team is trying to do.
Great.
At least.
Thank you. Ian, are there any concerning developments in the fixed income space that are keeping you awake at night?
Well, as Natalie said, there's lots of things keeping investment people awake at night. Yes, so globally, I think the big risk at the moment is that because the Fed started so late in hiking rates, the risk is that there's more policy error, that they just get fixated on inflation and they try and bite the bullet and not pivot, and they hike interest rates too far, because that has got a global effect. Because remember, the Fed sets the global dollar rate, and that could be not great for emerging markets. So policy error in the Fed, the ECB, and we're actually seeing some policy error now in the BOJ with what they're doing with yield curve control, which is not great. That's a real risk. The second big risk that we are seeing is that because of the volatility and what central banks are doing or not doing, that liquidity is going out of the usually very liquid bond markets. I mean, even US Treasuries aren't trading great. I mean, JGBs aren't trading great. We saw what happened to UK gilts in September. So, yeah, liquidity in bond markets aren't great. And then on the third level, EM is obviously not flavor of the month at the moment. And South Africa is not helping ourselves. The whole effect of continued load shedding. There's a lot of unknowns around policy in South Africa and politics, and even the grey listing, and we're not sure what it really means. We've got an idea, but we're not sure. So we're not helping ourselves. So in an unloved portion of the market, in South Africa, we're not helping ourselves, and that's why South Africa is a bit unloved at the moment in EM space. We actually need to get back into a space, and we can, because we've got good real yields, liquidity in our bond markets to get foreigners back into the market, but that may only change next year sometime.
So maybe just as a follow-on question, if you're running portfolios where you're trying to beat inflation, is inflation-linked bonds a place that you probably want to be in, or is that theme being overplayed?
I think it's probably done its bit at the moment. So you've probably had about a 5% return out of ILBs this year. But because of the big risk of environment, ILBs in South Africa probably didn't give you the return that you would expect, because you've had high inflation. Yes, you have the inflation carry, but now that, even the SARB has acknowledged that inflation has rolled over, we've probably seen the peak of inflation in South Africa. The accrual from the inflation side is probably not going to underpin ILBs anymore. So we think there's more value in nominal rates. Inflation bonds probably had their turn, and we think for the next year or more, nominal bonds look a lot more attractive, just on a nominal and on a real basis. So to give you a good example, so your 10-year ILB probably trades just sub 5%, but if you think that your nominal 10-year bond is probably trading close to nearly 7% real, so there's a much better real yield in nominal bonds than in ILBs at the moment. So we think the opportunities in nominal bonds and ILBs are not the best or favored asset class in fixed income for the next year or more.
Am I right in saying there's also not a lot of liquidity in the ILB space?
Limited liquidity. When you buy ILBs, it's definitely more of a buy and hold strategy, where we are still finding decent liquidity in the nominal bond space. But just on that topic, we actually thought that after the medium-term budget, National Treasury would actually cut the issuance of the ILBs, but they didn't, because they cut the floater, which we thought that wasn't that great idea, because the FRN, or the floater, is actually the cheap funding, and ILB is actually expensive funding for government, but be it as it may, National Treasury made their decision. So we are finding that the ILB auctions are now actually undersubscribed on a weekly basis. So it's not a great asset class at the moment, and to try and get in and out of positions is tough.
Great. I think that's one of the reasons you need a skilled manager to do it for you. Ronnie, we know you don't have a crystal ball, as Natty alluded to, but what are your expectations of the year ahead?
Yeah, Fluff. Look, I think my colleagues have already touched on a lot of the issues. We think there's still a lot of risk in the market. We are, for that reason, positioned very much in a risk-off stance in the portfolios. We're very thankful for our strategic asset allocations, which sort of anchor us to a base in the portfolios. Relative to that, we have taken slight tilts, predominantly to the risk-off side. We are underweight local equities. We're underweight global equities. We've added some global bonds. In the immediate term, it is not paying off, obviously, as Natalie has explained, but we are looking to that with a bit of a longer time horizon. So when inflation does eventually roll over and rates start coming down, we hope to see some benefit from that. But we have also added to our global cash positions, just given the strength of the dollar. I think that's a play that has played out quite well for us in the portfolios. So generally speaking, yes, I think there's a lot of risks. I'm not going to repeat them all, but it's all the same stuff that everybody's talking about. It's recessionary fears, it's inflation, is the rate hiking cycles from the central banks, etc. And then locally, of course, we do have a lot of issues. You've touched on some of them with load shedding on a ground level, but right up to the grey listing and what that could potentially mean for us from the impact on GDP and foreign investment and the red tape that comes along with that. So there are still a lot of challenges that lies ahead. We don't know how the rest of the year is going to play out, but hopefully, markets are down 29% if you look at EM. So we think, perhaps some of the worst news is already possibly behind us. We certainly hope so. October has been, as I've mentioned, has been quite a good month. So yeah, we are positioned for risk off, but we hope for the best.
Okay. So Dean, are there any new initiatives or changes that you think we should expect in the coming months in the two ranges?
Yes, some of the things we are quite excited about, particularly in the model portfolio side, is the launch of the Momentum Sustainable Equity Fund. So that is a multi-factor global equity fund that gets us exposure to momentum, quality, and growth, or rather momentum, value, and quality, rather, through stock selection, as well as a sustainable or ESG overlay. So, we are quite excited about that, to plug into our global equity. We have been using Momentum Global Equity Fund or Momentum Global Growth in the case of the model portfolios. What we like about this fund in particular is you get this, almost passive smart beta execution. So there's also an immediate fee benefit that you get there. But, what we've seen, in a lot of research is that it's very tough to outperform global markets and to do it consistently. And of course, when you try to do that from a local perspective, the hurdle inevitably is fees. So, on the average global equity feeder fund, the TICs range from sort of 2 to 2.5. So you'd have to believe that they'd be able to outperform markets by 2 to 2.5% consistently through time. And that's just to cover for the fees, not even to give you upside. So, we do think that, the cost effectiveness of the fund, as well as the potential for alpha over the longer term, gives us a very nice, reward payoff over the long term and a very nice profile in there. It is a developed market only fund, so we would have to obviously supplement that with, good global emerging market exposure. In the case of the model portfolios, our preference there would be, something more, again, in the more passive space. So something like an ESG tracker in the EM space. In the case of the fund of funds, they can obviously have some of the additional flexibility to buy directly offshore. And in that instance, the MGIM Global Emerging Market Funds looks very attractive. And then one maybe for more longer term growth opportunities is that the Momentum Future Trends Fund, which, the audience may have been introduced to, which is going to be run by our colleagues Jaco de Jager and Eugene Buerta. So that is almost a unique fund that looks to identify 6 long-term growth trends in the case of AI, space travel, water sustainability, etc. And so that fund has recently been launched in September, and that's something that we would start to look to include in the portfolios, just given the constrained real return environment, something that will give us sort of a long-term growth edge. Of course, it is going to be potentially a racy fund, so we don't want to allocate massively towards it. We will take on risk, but it is something that can be a growth underpin for your global equity allocation and offer you a bit of differentiation as well.
Oh, that's fantastic. I recently attended our think tank conference, and it was interesting to see how many managers from around the world were talking about sustainable themes and being more ESG focused, and a lot of research showing that the integration of ESG into funds actually does lead to better performance long term because of the sustainability issues. So that's fantastic to hear. So Ian, how are you differentiating yourself in an asset class that's often thought of as a vanilla asset class? What do you think you do differently to some of your peers?
Interesting when you call it vanilla. There's nothing vanilla about fixed income. Remember, we've got Eskom as a counter, which no other asset class has. So enough of that.
So maybe tell us what you think are the best opportunities and what you'd avoid at all costs.
Okay, so differentiation to me is like at 3 levels. It's obviously is our valuation methodology, and that's 2 layers. Firstly is getting our clients on the right yield curves. And remember, there's 7 yield curves in South Africa. We manage assets on 6. So getting that split right between nominals, ILBs, cash, credit. But it's also the second layer is getting our clients onto the right points on each of those curves. Now, valuation methodology and philosophy hopefully get you over time into the right positions on the various curves. I think the differentiator in the second level is credit, because there's such a binomial outcome in picking the right credits versus the wrong credits because of probability of default. So it's quite important for us, and I always say fixed income is not always about running your winners, it's avoiding the potholes, and that's quite important when you've got a credit play, is to avoid the potholes. And I think the third part that's really a differentiator is for us is that we've got access to the private debt market that a lot of our peers don't necessarily have. Remember, we manage assets on that high yield curve where we actually get into the bilateral private debt market. That's because the listed debt market sometimes has got very expensive pricing, but the private debt market really gives us the opportunity to negotiate better deals for our clients, get us more protection, better pricing, and we're really seeing a lot of opportunity there. Talking about ESG, we're getting into sustainable financing, into infrastructure, into IPPs in that private debt market, not necessarily in the listed market. So I think that's really a differentiator for us, is to be in the private debt market.
Great, thank you. We know us ladies always have to have the last say, so I'm going to ask Nats for the last question. What's your thinking on the year ahead, and what opportunities do you think you're going to be able to take advantage of? And feel free to share anything you're going to try and avoid as well.
So Fluff, with our crystal ball, we're going to try to time the market perfectly and buy into the asset classes just at the right time. No, I'm joking. So I think the reality is that we've got markets have been in declines, as we've all been talking about. But when markets are pricing a lot of fear and of uncertainty, a lot of opportunities naturally come about. And for us, we've going into 2022, we're actually also underweight global equities because valuations were pretty high going into 2020 after an amazing run in global equities. You alluded to it earlier, the only real place to get real returns was global equities pretty much for the last few years. And given those high valuations, we were underweight. And as a result, I suppose now, with the markets having sold us so significantly, an area that we may start to look to dabble in down the line is equities again. We don't think it's the right time right now. As I said, it's difficult to time that because there could be earnings surprises that come through with inflationary concerns, eating up margins, but it is an area that we continually look at. And that's when obviously an investment team like our team in the UK, that's what they spend most of their time doing. And an area that I think really is exciting us which is an interesting thing for us to say, is global bonds. Ronnie had mentioned that, you guys have started to dabble in global bonds. I mean, we haven't done this for a long period of time because real yields are exceptionally low. It didn't make sense. After an exceptional bond bull market for many years, bonds were just exceptionally expensive. So you had to diversify your fixed income bucket elsewhere to enable you to achieve those return targets that you wanted. So, now with the yields rising so significantly as a result of rising interest rates, they're starting to look more attractive. We're not going to throw everything in there. We're not going to increase our duration so significantly, but it's definitely an area that we're starting to dabble. And it's great that we've got that optionality back again. Other areas, we continually think that it's important to have exposure to real assets. If inflation does become persistent, as I mentioned, we do think it's going to come down, but infrastructure assets, as an example, is a great asset class to have. There's a lot of ESG credentials in that space, so that's always a useful asset class. And I think, just always, from our team, we're just continually looking for opportunities to use that cash base that we've got to buy into attractive valuations where we see fit. I think just, importantly for investors, it's been very difficult, and we all are cognizant of how hard it is for clients to see their statements hopefully not every month, but it's such an important point now, particularly when it's, to have grit, to stay invested, because trying to time the market entry point is really difficult. That's why we remain diversified across the board. But when those markets do change, they can turn very quickly. Some tailwinds that can come through, Ian alluded to earlier, the Fed could start cutting interest rates next year. That will be very good for the US dollar, in the sense that you'll see the dollar strength start to unwind. Other asset classes could perform really well as a result. So there's a lot of tailwinds that can suddenly happen that can boost asset class prices, and a recovery can happen very quickly. And if you disinvest at the wrong time, you don't partake in that recovery. So just have grit, ensure that you stick to the investment plan that your financial advisor, your MFP advisor, has set out for you, and just remain invested, because opportunities are rising, and the team of investment professionals are obviously positioning the various portfolios to take advantage of that.
So thank you to all of you for sharing your valuable insights with us. It gives me a huge amount of comfort to know that we've got professionals worrying about their investments every day, so that advisors can focus on what they do best, and you can go out and spend time with your clients, making sure that they do stay invested. I think the point that Natalie made is probably the most important point today, and that's the one thing that's worrying me the most is when I look at advisor books and I see how many advisors are de-risking their clients. Now, the issue with that is in volatile markets, when we know that assets are often cheap, you are disinvesting at a time when the market has already given you negative returns. And so what that means is that you're actually locking in those negative returns or losses. And then if you're not invested, when the market does turn around, you have a double whammy, because you also don't get the benefit of the full run in markets when they do turn around. And so my advice would be, stay invested. If you're not in the markets, this is probably not a bad time to start thinking about getting in, whether you're phasing that in or going all in. There might still be a little bit of short to medium term pain, but being invested is definitely better than not being in the markets, because then you can't take advantage of any of the asset classes, whether they're local, offshore, fixed income, equities, or multi-asset portfolios. So thank you very much. And to all the MFP advisors, thank you for your ongoing support. We know it's been tough. Look how much we've aged in the last year. But we're here as your partners in the investment journey with your clients. Please lean on us. And we really are hoping that at some point, we're going to be sitting here with good, positive market returns. Thank you for your time.
Thank you for that impactful discussion, Fluff. Lots of takeaways there, in my opinion. Next up, though, we've got Willem van Zyl, who will then sum up and tie the conversation back to the MFP advice process. Willem, welcome to our virtual stage.
Thanks, Andile. Good day, colleagues. Thank you to our presenters and for taking us through the technical aspects of investing and what we can and should expect in the foreseeable future. The question that I think remains with everybody is, how do I practically make sense of all of this for my clients? The advice that was given was sound based on their circumstances and needs at the time. But as soon as a statement goes out to a client and the reality of the downturn in the markets is seen on paper, I, as the advisor, have my hands full to keep my clients calm. What do I do and how do I do it? I do not have all the answers, and I believe there might not be one answer that will suit all situations that you are faced with. But I want to try and link what we have heard today with a possible discussion with a client. Please note that I'm not an investment expert, and my answer to this question might fall short from the way that you as an experienced advisor would have dealt with this. But I'm sure that this could be a good starting point for any such a discussion. As always, I would like to first quote Sir Winston Churchill. He once famously said, "Never ever give up unless it's a matter of honor or common sense." I think this is applicable and appropriate to this situation. Some time ago, I spoke to one of the investment advisors and I asked her, how do you deal with it when your clients are scared if they see a paper loss? She told me that she had to find something to compare this to what is practical for a client to understand. She tells her clients that investing is like farming with cattle. During wintertime, when the grazing is not that good, your cattle is not in the best condition. But they are still there. You don't sell them unless you absolutely have to, which is the common sense part that I referred to in the quote. And you normally sit it out then until summertime, when the grazing is better and their condition have improved. Just like there are different seasons, there are different cycles in investing. We are currently facing headwinds, but it will get better at some point. Like I said, it might not be applicable under all circumstances. Hence the reason why you are there to guide your client. But the point that I'm trying to make, and which links to what Kapila said, is stay invested. Don't cause a disastrous effect which could have been avoided by using common sense. Investors cannot control a market crisis, but they can control how they respond. This is probably your biggest challenge, and the fact that you sometimes must answer why you still earn a fee when they are losing money. The answer is relatively simple. You are the person that has the experience and the know-how on how to guide them, and your job remains the same in good and in bad times. What is great to know is that Momentum Investments have partnered with us to provide solutions that would assist you with guiding the client through the challenging times. The focus of the strategy is to lessen the advice risk. You don't have to focus on asset classes, portfolio construction, whatever. Your focus is on matching the needs of the client with the right strategy and the solution, and to assist your client to make sense of the changes in the seasons which will inevitably happen. You might ask, why this message, Willem? Rupert Giesing, Business Development Manager at Equilibrium, recently showed us in his MFP House View report that especially in the I channel, there was a net outflow of money from external funds into House View solutions of approximately 74 million rand. On the surface, this is good news for the House View solutions, but upon further analysis, one sees that the majority of the money went into internal cash and income solutions. Inflows into our House View multi-asset solutions, both the MFP Focus model portfolios and the Momentum Focus fund of funds, has also dramatically reduced over the last quarter compared to the first half of 2022. The question is whether this was the best advice at the time for the client. Whilst we have great internal House View solutions, which we as MFP management endorse and support, we also support and endorse the investment principles of staying invested and not to try and time the market. As I mentioned earlier, I don't have all the answers, but the one thing that I am certain of is that a well-diversified investment strategy over the recommended investment horizon is the best defense against market uncertainty. Economist and Nobel laureate Harry Markovich famously called diversification the only free lunch in investing. This is exactly what we have in our in-house multi-asset solutions with the MFP focused model portfolios and the momentum focused fund of funds. Thank you for attending this session. Good luck with this next quarter, and thank you for your business.
Thank you, Willem. Next up, ladies and gentlemen, our CEO, Dani van der Berg. He's going to close the event for us. Over to you, Dani. The virtual stage is yours.
Thanks, Andile. Hello, everyone. And maybe, actually, thank you, everyone, for attending this session. Yes, outcome matters. The word says it all. You matter. That's why there's been so much effort into this, giving you great insight into what you need to tell your clients. But what I do think, if I look back at what's been communicated, it doesn't look, like good news. But what we need to take from this is we need to actually view it in terms of what do we go and tell existing clients, because we need to go back with them with conviction and authority in terms of this is our stance and this is what we advise you to do. But also, then we need to obviously look at new business. And I actually think we underplay that one, because clients cannot afford not to invest at this stage as well, as we just need to do the responsible thing. And that's why we have house view portfolios, because our house view portfolios actually would give you that comfort that we would do the responsible thing at that point in time for over the time that you are investing in. So yes, it still remains. The client benchmark matters. This is why it is outcome matters. And you matter. Thank you for attending. I hope you got something worthwhile from this to go with confidence to each of your clients. Thank you very much.
Just a reminder to watch the full session and add your ID number to the CPD section so that we can verify your attendance. Also note that our event platform will remain open until the end of December for you to still view this event and still receive your CPD points. Thank you for watching. Goodbye, good riddance, good luck. Take care.